This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
You know what, Carol?
What?
There are kind of like a few, I don't know, things that are just staples of the holiday season. So think about this for a second. Eggnog, the Rockefeller Center Christmas tree.
Love that.
Carol's famous holiday cookies, which I'm told include homemade shortbread and peppermint bark. Yet I've never actually eaten, but I've told that you do this every year. I've known you at this point for almost 4 years, and I still have never tried these. But it's a holiday tradition.
It is a holiday tradition. I'm trying to get back to the tradition. There's reasons why it's been on hold, but I know I owe you and a lot of people some cookies, so we'll work on it.
You don't have to. It's okay.
I'd love to. Amaretto balls, they're really good. All right, but in terms of traditions, one of the things we always look forward to is PNC Asset Management Group's Christmas Price Index. This index, or CPI, calculates the true cost of all 12 days of Christmas. So all the gifts, all of the calling birds, gold rings, swimming swans, milking maids, and pear trees.
Amanda Agati is the Chief Investment Officer at PNC Asset Management Group. She joins us on Zoom from Philadelphia. Amanda, good to have you back with us. You know I've been waiting 11 months for this.
So much fun.
We love doing this each and every year. I got to tell you, the headline number here is quite a bit different than last year and kind of makes sense when it comes to I'm not going to say the slowdown that we've gotten in the economy and the prices that have not risen as fast as they did last year. It's not as shocking to buy that pear tree this year.
It's not quite as shocking in general. I'm so delighted to be back with both of you. This is so fun. Such a fun annual project. I cannot believe we've been doing this. Well, not you and me, but PNC's been doing this for 40 years.
Wow.
So it's the 40th anniversary. I'm not going to age or date myself anywhere near.
Wait, so what did it cost? Wait, so 1980s first time? 83?
1984. Yeah.
Do you remember what it cost?
Oh my God!
She wasn't doing
I was
it.
a babe
I'm not
back
going to do that.
then.
I'm not going to do that
Carol,
to
she
you.
wasn't doing
Okay.
it.
All right. So talk to us about today's tally.
So last year, just to tee this up a little bit, last year the increase on a year-over-year basis was a whopping 10.5%. Right, we were right in the thick of a really hot inflationary environment. This year, I'm happy to report that we're gaining on it in getting this inflationary battle under control. And so, as per the Christmas Price Index, we're only up about 2.7% year over year, and so that equates to a little over $46,000 in total to buy all 12 days worth of the gifts.
The long and variable lag is hitting the 12 days of Christmas. I mean,
how about that?
I will tell you though, Jay Powell would be happy to have inflation at 2.7%. You guys are, you're doing the,
this is a key data point that the Fed and the FOMC is very much focused on naturally, right?
Well, you know what's interesting? What do you guys find when you do this index, how much it really does kind of tell you about where we are in the inflation cycle? And I went back to 1984, courtesy of you guys. It was $20,069.58.
Yep.
A little perspective.
Many moons ago.
Right?
Yeah,
A little perspective.
I think the big thing for us is really trying to get a sense of the health of the consumer. So what is the consumer facing in any given holiday season? Where is the supply and demand sort of disconnect or perhaps alignment in any given year? And what does it ultimately mean for the path forward for markets and the economy? You know, consumption is such a huge component of growth over time. And so we got to make sure we understand what the consumer trends look like. And so this is an important piece of analysis, though lighthearted. It is an important piece of analysis.
Is it really like, do you really like, you're like, okay, this shows us, you know, food costs or something, like it really does track with what's going on in the real economy?
I think it does. It's obviously a specialty gift basket of goods and services. And so it definitely is an indication of maybe the higher end consumer discretionary oriented trends that the economy and consumers in general might be facing. But it is interesting to watch the trends from year to year. It does track pretty nicely.
Okay, well, let's get to some of these individual items. Because I want to make sure we get to all this, Amanda. There was actually no deflation in this. So there were certain items that don't cost any more than they did last year, but nothing actually went down in price. What sticks out to you?
That sounds about right. Yeah. So 5 of the gifts in the index, 4 calling birds, 5 gold rings, naturally my favorite gift, 7 swans of swimming, the 8 maids and the 9 ladies were all flat on a year-over-year basis. So if you're looking for a gift this holiday season, maybe those 5 gold rings are kind of a deal on a relative basis here.
Yeah, but don't try to buy Lords of Leapin, right?
No, so we certainly saw an increase there. And I think this is an important tie-in to what we're seeing in the services side of the economy. Try as the Fed might to get this inflationary backdrop under control. Services inflation tend to be pretty sticky. The Lords certainly fall into the live performances or services category. When we break it down between services and goods, the services component of this index is up almost 2 times what the goods side is. So pretty notable there in terms of that dynamic.
It's like the Taylor Swift effect.
Yeah, exactly. Although
absolutely,
the turtle doves, very pricey this year compared to last year. 25% higher? Why are turtle doves so much more expensive this year than last year?
So I think, well, on the one hand, it's a fairly limited supply in terms of the breeders that we talk to.
It's the Bitcoin of the dove world, you're saying?
Yeah, you could equate it to that, but very limited supply. But I also think demand in this environment for specialty doves is perhaps a little bit less. I don't know that consumers are backing up the truck for specialty doves this holiday season.
It's just kind of, I love it.
Is that on your list, Carol?
What?
Specialty doves this holiday season?
Absolutely. Top
partridge.
Of the list.
What about a partridge?
I'm more like
and
a piper's
tree?
piping kind of gal.
Well, that's going to be more expensive because the price of musicians has gone up.
That's right.
That's exactly right.
Did anything surprise you in this year's reading?
I think 2 things probably surprised me the most. The one is that when we look at the core version of the index, so we try to mirror the BLS's methodology and we back out the most volatile component in the Christmas price index. It's food and energy for the BLS. For us, it's the swans. And this year, the swans did not move at all. And so I think that's pretty notable. It's the single biggest line item and it didn't move at all. And so we sort of think about that as perhaps investors have been bracing for black swan sightings all year, given recessionary concerns lingering that have failed to materialize. And then the other component is that the cost to shop online are up significantly. You're not going to get a deal this year in the Christmas price index by shopping online. So the convenience component of shopping online may allow us to slay our gift list all day, but it's definitely going to cost you.
Why are the swans so expensive? Oh, they're not expensive. Why are they not?
The swans are expensive. They're the single biggest line item in general, and they tend to move around a lot year to year. But yeah, not this year. Not this year.
I haven't gone swan shopping in a while.
I've actually never gone swan shopping.
You should try it.
Yeah.
It's kind of fun.
We should plan to do that in the new year.
We have Amanda
Trip to
do
the
it,
mall,
so
right?
then she comes and tells us the price.
The Swan Mall. Amanda Agati, you're so much fun. Happy holidays. Chief Investment Officer, PNC Asset Management, on Zoom from Philly.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
So excited about our next guest. So much going on, as you know, at the intersection of sports, money, and education, which is why this next story, we're going to kind of start here, is on our radar. It's courtesy of Bloomberg's Jillian Tan. She reported last week on Patricof Company, which works with athletes and entrepreneurs to invest in private equity. The company, along with more than 50 of its current and former athlete clients, including Philadelphia Eagles center Jason Kelce and
I've heard that last name before.
West.
Okay.
Jason Swift. Oh, wait, can I say that?
Jason's a cool
cool one, right?
Jason's the cool one. You are hearing the voice of Mark Patricof, founder and CEO of Patricof Company, joining us here in our Bloomberg Interactive Broker Studio. Just so you know, you're here for the next 60 minutes. No, next time you're going to be here for the next 60 minutes.
Yeah, it could be like the third,
How are you?
third host
I
of the
love
show.
coming to see you.
Well,
this is an opt-in choice, not a you have to go do this choice.
Well, we love having you. First of all, tell us about this deal. IMG Academy, I wasn't that familiar. Did kind of a deep dive, but tell me why you guys are doing
I bet
this.
you loved tennis though years ago.
I love gymnastics. I was a gymnast.
Well, a little bit less so, but relevant to IMG, they have been gymnastics. But I remember when I was in high school, I had friends who, if they were really good tennis players, all they wanted to do was go to Nick Bollettieri in Tampa.
Yes.
And that is IMG Academy, by the way. So that evolved. Ultimately, IMG acquired Bollettieri, changed the name. And it's always been the preeminent place for, in some cases, privileged, but as it's changed, for underprivileged.
No, I mean,
and
Agassi didn't pay a dime to get
Yeah,
there.
exactly.
Yeah.
So on one hand, you kind of knew the brand. I did a lot of investment banking work for IMG when they were an independent agency. When Endeavor bought them, I stayed in close touch with IMG. Mubadala invested at the time. I was involved in that transaction. And one of the heads of the head of corp dev at Endeavor, a guy named Brent Richard, who was an old friend of mine, we've been on the opposite side of a couple of different banking deals, ended up as part of his role in Endeavor, taking over this acquisition they had done with IMG and focusing on the academy and seeing a really big vision for-profit education, democratizing, I think, access to the best coaching.
Well, yeah, I just wanted to jump in just because when you talk Bollettieri, it's funny, we did the US Open this year. I got super into tennis again, read Agassi's book. He talks about his experience at Bollettieri. One thing that he made
hate probably, right?
Yeah, more hate than love, for sure.
But
especially, it totally worked.
That's right.
And Bollettieri for years was his coach.
Yeah.
But one thing that he talked about was academics. And that's in my experience too, with growing up in California and seeing other tennis academies, the tennis was great. Academics were lacking. Talk to me a little bit about IMG's approach to academics.
I will. And I'm sorry to interrupt you. I will do a little plug here, but it'll make sense in a second. I've been the chairman of the board of a charity in New York called New Heights Youth. It's a basketball-related charity, but we use academics as a benefit for getting good coaching. So we've sort of said, look, if you can be part of a team, if you can consistently commit to what's required to be on a team, you can do the same thing in the classroom. So if you want our coaching, we're going to force you into after-school programs, SAT prep, college, admissions process, help. So IMG has done that at a much greater scale in a for-profit way. So yes, academics is a story here today. Athletics is what has always been what people talked about, but it's the combination of the two that is really what's interesting here. So using sports as a hook to bring in kids, either underprivileged or privileged, put them into the right types of programs to professionalize in their minds how they take advantage of this physical skill they have off the court, off the field, and to have better, bigger, more fulfilling lives because of it. And there's proof points across the globe. So when IMG sold, itself, Endeavor sold IMG Academy to EQT, and Norda and Glay, the opportunity was here to globalize a really interesting methodology that has changed people's lives for many, many years. And Andre's a good example. He probably wouldn't be the Andre we know, Venus Williams, in the long list of people who have created discipline in their lives, learned how to exercise one muscle. If they can do that successfully, realize they can exercise their intellectual muscles too. And IMG is a really phenomenal, I think, academic process to do that.
And the assumption isn't that everybody's going to become this big professional athlete, but it's
very few make it to the pros.
Like kind of like a great finishing boarding school, right?
Of course. I mean, it's one way of looking at it. I mean, at New Heights, IMG too, if 5% of these kids go and play some level of professional sports. Remember, professional sports, take basketball. It isn't just the NBA. There's leagues in Italy and France and Greece and Israel and many other places. Brazil, great players coming from all over the world now. So that's the other opportunity here with IMG Academy, and why they chose EQT and why we could be helpful is there's a real opportunity to globalize this.
Speaking of globalization, there's so many places I want to go with you. PGA and LIV, they're supposed to, I think, there's a deadline at the end of this year for this merger. I
think we talked about it this spring as if it was a done deal already.
Yeah, it's tick, 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 tick. It's coming, or it's expected to. What do you think happens next?
I don't know. I mean, it's very hard to say. I think it's been
Is this a good thing?
Absolute. Look, I think anytime people have an opportunity to be paid fairly for their talent is a good thing. So if it's one league, clearly, that caps to some extent what someone can make. I think competition ultimately is a good thing.
Yeah.
I think the way it's been managed has been quite poor. I'm really pretty certain that the JP Morgans of the world, who happen to own, here, just in full disclosure, 20% of my business.
Yeah.
But who are the biggest sponsors of the U.S. Open, for example? I'm sure
Right.
they were. And by the way, the Masters and other things like that. I'm sure they had a loud voice when this fell upon us in the spring. So, I think it's a good thing if it helps, democratize golf, so more people play golf, more people see golf, more people attend golf tournaments. I mean, it's been for the privileged few who get to go to see the Masters or go, watch any of these tournaments. And I hope something good comes of it. I mean, I think TQL is interesting, which is the new indoor league.
Right.
We'll see if that just got delayed. It's an interesting way to take a sport that's been for very few people who could afford it. So if LIV and PGA come together, you have to see what that means.
TBD.
Yeah.
Hey, listen, we've only got a couple minutes, so you've got to already promise to come back really soon.
Always.
But 2 minutes, the world's pretty stressful, to say the least. And who'd have thought, just kind of this year, the stuff that we were talking about seeing, living. Athletes, what's their role in all of this? And we're getting ready for a really important presidential election in the United States. What's their role, or should be their role, where it can backfire in an instant?
Used to be, I think, in the locker rooms of the old days, you didn't talk about money, you didn't talk about sex, and you didn't talk about politics. I think in the last cycle of professional sports, where these kids are seeing the world in a very different way, they're learning more by accident or intentionally at a much younger age, they are forming opinions. They're realizing the power of their brains, back to IMG Academy. And I speak to athletes, most cases 7 days a week. They'll bring up, what do you think is going to happen next November? I don't like this candidate. I do like that candidate. And they're starting to understand that if they decide to amplify a point of view that's well-informed, that could be influential. I mean, not to make it about diversity, but you think about Obama and Oprah and the impact she had. The number one, I'm going to use this example because it's kind of off point for the U.S., but the number one cricket player in India has 250 million Instagram followers. I don't have offhand how many Instagram followers Joe Burrow has, or Kyrie Irving, but you saw what Kyrie Irving did last fall.
Right.
They can make a difference. And if athlete A doesn't want to see Donald Trump become president, he or she has a voice. And I think you're going to see a willingness that you did not see in the past, other than from a very select few, to use that voice to, I think, a positive end. And any opinion's a good opinion. I always say that about athletes. And, just have an opinion. I don't care whether you go left or right or do this deal, don't do this deal. I just want you to have an opinion. So we say that a lot to them about politics. Have an opinion. It matters. It's going to affect your lives.
As I said, promise to come back soon, because we'll do more. We will, obviously. Mark Patricof, President and CEO of Patricof Company, joining us here in studio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, the CEOs of some of the biggest U.S. banks, including Jamie Dimon of JP Morgan, Brian Moynihan of Bank of America, and Jane Fraser of Citigroup, spent much of the day testifying before the Senate Banking Committee. They made a lot of news. Perhaps unsurprisingly, they rallied against regulators' proposals to raise capital for the biggest banks. Here's JP Morgan's Jamie Dimon.
We had 10 years to do this. And it's shocking to me that we're sitting after 10 years and we're talking about what's it going to do for small business, and we have to analyze it today. It was not thoughtfully done. I'm not sure it was shared fully among all the regulators. This should be relooked at.
All right, that's Jamie Dimon, of course, CEO of JP Morgan up on Capitol Hill.
He doesn't mince words.
No, he's not bashful at all.
No, he's not. He went on to say that they will hurt lower income borrowers. Goldman Sachs CEO David Solomon called the new rules, quote, punitive to economic growth. Oh, and Senator Elizabeth Warren actually found some common ground, Carol, with some bankers.
Yeah, she did. Sonali, Basak and Kat Doherty, they've been all over this story today. Sonali is Wall Street reporter for Bloomberg News. She's in our D.C. bureau, back from Capitol Hill, where she's been since the early hours of the morning. And Kat, of course, is finance reporter here at Bloomberg News. She joins us in the Bloomberg Interactive Broker studio. Sonali, let's start with you. It's an annual thing, but give us some background, history, origin of these get-togethers between Wall Street and Washington. And I'm glad you're back in where it's warmer.
Yeah, exactly. It was quite cold outside this morning. But yes, these hearings really started back by Maxine Waters back in 2019 at the House. This year it wasn't at the House. It was mostly at the Senate. And so the Senate really has shepherded this since 2021 under the leadership of Ohio Democratic Senator Sherrod Brown. There were a lot of reasons that this was happening. One is a lot of concern about banking services in low-income communities, in rural communities across America, right before the pandemic, really, a couple years before the pandemic. In the wake of the murder of George Floyd, that was a really important moment in all of this as well, because the banks were really pressed on their commitments to racial equity across America, why black homeowners were not getting mortgages at the same rate in a refinancing boom in really the lowest interest rates we've seen in a generation. And now on the flip side, they're getting questions in the other direction. Why is it so hard for everyone to get a mortgage? Why are they retreating from the mortgage business at such a fast clip? And a lot of that they can blame on regulation, and they certainly are using this moment to blame regulation for why they are getting out of certain businesses in certain areas across America.
But I mean, regulation is one thing, but mortgages are down because rates are up, Kat. So, you know, the Fed has raised rates to tame inflation, and when you see the rise in rates, you see the mortgages get more expensive.
The big banks backing out of the mortgage business it was before interest rates started going up. And it tracks back to, or it comes down to, is it a profitable business? And okay. Dimon had a quote today where he basically talked about loans. It could apply to mortgages, just lending in general. When these banks are looking at each business line, especially the big ones like B of A and JP Morgan that have different units that all have to report up to the one entity that ends up saying how much revenue they're generating each year, and they have to show that to shareholders. If there is something that is not making them money and it ends up like the math doesn't work out, they're going to make that business decision to say, this is not something that is benefiting our business. And they do have to, the only reason that like a Bank of America hasn't exited completely from mortgages is because they want to be a provider for their clients in a wholesome way. So if you have someone that has a checking account, a saving account with you, and then they come and they say, I also want to have a mortgage with you, they want to say, okay, we can do that as well. But they're not doing it in a big way. They're not going out and I don't think that I would be surprised to see an advertisement from one of the big banks saying, hey, you can have a mortgage with us, because it's not something that they're touting.
That's interesting.
So it really isn't tied to interest rates going up. You make a good point of where we're at today, and that there aren't as many folks out there looking for mortgages because people are sitting and waiting for interest rates to go down. So yes, in this economic environment, the banks, even and non-banks that provide mortgages, aren't lending as much for housing. But that doesn't have to do with the bank's business decision to back out of that business.
Yeah, I think it's kind of interesting. I think about the Wells Fargo remote that we did, that really trying to, I mean, they've got a lot of issues, or have for years, but really trying to move in terms of their diversity lending, and because there's been a lot of criticism for them specifically. Sonali, what stood out for you in terms of the questioning? It's always kind of remarkable when I see like a pan of a camera against these very notable CEOs, many of them, most of them, a lot of them, household names. Like, we know who they are, people in general do, and we follow them very closely. So what was notable for you?
one moment that was the most notable was an exchange that Senator Elizabeth Warren, who is typically the toughest on the banks, that she had with the bank CEOs. She seems to have turned her focus very largely to crypto. She has been very focused on the abuses in the crypto industry, particularly when it comes to anti-money laundering. And she asked each of the bankers whether they agree that those crypto firms should be subject to the same anti-money laundering rules that the banking system is today. Each of them said absolutely. And so you had this strange moment that hasn't happened for years so publicly, where Elizabeth Warren and the banking system were on the same side. I did catch up with her right after the hearing in person as well, and one thing I asked her that she would not explicitly answer is whether she would be willing to regulate the private capital system. And this is a system, for example, private credit has ballooned to a $1.5 trillion industry so far and fast growing. And that's where the bankers are trying to draw their attention to, saying that if you squeeze us more, most of the activity is going to non-banks. They point to private credit in particular, but even the mortgage system is now the top 3 by the number of mortgages originated last year. None of them are the big banks.
Kat, I feel like the big
Kat's
bankers,
just nodding her head in here.
the publicly, right? They've got to be bristling, right?
Well, yeah, Sonali's tying it all together, right? Like when you talk about the CEO showing up today, and they were just guns a-blazing going after new regulation that they're facing, and there was a big emphasis on saying, if you do this, they said, number one, we'll be able to handle it. It's not as if our balance sheets aren't strong enough to take whatever you're throwing at us. However, we're going to back away, and this will push businesses, if the businesses that we back away from, or we're like pulling back because we have to abide by this new regulation, others will step in. And that means that the activity that you're trying to regulate will just move to an area that you can't even see what's going on.
The so-called shadow banking.
The shadow banking, the private credit market. So it really it's an interest. Like you see the activity already happening, and they're capitalizing on that. They're trying to point out that the intention of Basel III might actually start moving the activity and be the opposite. It might be into an area that's not protected, not regulated.
If I have time, I want to ask this of both of you, but are they right, Sonali? And I mean, just as both of you, look at private credit or the private world, you look at obviously the publicly held banks, increasingly we're just seeing that private lending world just kind of continue to grow and be a bigger part of kind of the lending world. And I do wonder, we all wonder, what's going on that we don't know about.
Listen, there's a really interesting report that we're going to be writing about later this week that basically cites that, and it's a giant in the industry that's going to be talking about how private credit is actually a bigger problem in terms of potential defaults in the future, because it's hidden all those problems, and they're medium and small businesses, although not so small that they're still missing a large swath of society here. Can we also just talk about how much the narrative has shifted? Because this used to be a quite hostile affair in the last several years. The last couple of years they had these hearings, and it's almost like the tides have shifted. The banks have understood that they need to play ball with these regulators and these lawmakers. If they play ball in some ways, then they get other things in return. And by the way, they were the big saviors of the industry this year. They got together, they put capital together to make sure that one bank didn't fail in a disorderly manner. It's amazing how they have, and I've got to say, this morning, the first thing I saw this morning was David Solomon hanging out with James Gorman and Brian Moynihan coming to meet them. And it's kind of like they've all gotten their act together. They have a coordinated message, and their message is, we play a role here. We play an important role here. You're not going to want to shunt us too badly because you need us. And the lawmakers seem to fall in line with that story.
They know how to play the game. They're walking in here today, and they have a strategy. They're saying, like, here we are, and we showed up during the regional banking crisis.
It's a really good point. Guys, we have to run. Love it. This was such a good roundtable. Sonali, Basak, and Kat Doherty.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is The Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody. Just about 18 minutes left in today's trading session. Yeah, we're at our lows of the day when it comes to the equity trade.
Yeah, but as we just heard from Bill Maloney, we saw early gains in the day. It's kind of an interesting move, right? If you go to HCPI-D on the Bloomberg terminal, you can see that S&P 500 was up as much as half a percentage point early in the session. Lows of the day, about 0.4%. So, quite a bit of move.
Yeah, that was then. That's not now, though.
Yeah, you're right.
Just giving you a hard time.
Someone's already on vacation.
I'm just a little surly. All right, so let's get to it because our next guest expects 2 to 3 rate cuts in the new year. With more on her thinking and what that may portend for U.S. stocks, it's time for the drive to the close. Nadia Lovell is with us. She's Senior U.S. Equity Strategist at UBS Global Wealth Management, and she's with us on Zoom in New York City. Nadia, how are you?
I am well. How are you?
I'm doing okay, doing well. Ready to kind of put a bow on this year, to be quite honest. It's been dense. It's been a lot of stuff, a lot of big stories, and a lot of twists and turns and volatility for investors to deal with. So let's get to your premise, your macro environment for the U.S. equity market. 2 to 3 rate cuts a year. Why and when do you anticipate that they might come through?
We think that actually won't come through until the middle of the year. We actually think that the market current pricing is a bit aggressive. We've seen this massive pendulum swing to dovish a bit too quickly from our hard pivot from higher for longer. And now the market is pricing in over 130 basis points for cuts next year. I mean, even Chairman Powell tried to push back on this last week, even though a bit unsuccessful. But we think that the Fed is going to remain patient. We should start to see inflation moderate further in the first half of the year, and that will put the Fed in the position to cut. And one could argue that the financial markets is actually already doing some of the work for the Fed. You did see a massive easing in financial conditions in November, like to the highest, sort of the biggest drop that you've seen in multiple decades. And so we think that the Fed will use that to its advantage as well.
What's the concern, though, that could actually change your hypothesis of 2 to 3 rate cuts next year? What would cause you to reverse that view and say actually the Fed does need to hold rates higher for longer?
It will be the inflation outlook. I mean, growth seems to be holding in there, and the disinflation trend does seem to be broadening out. But if we do get a pause in that and sort of any re-acceleration or stall out in inflation, that could keep the Fed higher for longer to make sure that inflation does not raise its head aggressively again. And so if we don't see inflation, and we might get a hot print next week, I just want to preface that, but we don't think that one data point is going to change the trajectory. But if we get a few hot prints, 2 or 3 hot prints, that could keep the Fed higher for longer.
It does feel like now that we can see the light at the end of the tunnel when it comes to perhaps Fed policy. What is so important is, I feel like, Tim, those trend lines. Yeah. We were talking about that with Michael McKenzie, like this idea that the monthly jobs report that we get on Friday, it's not just the November read, it's the December read, it's the January read, it's the February read that gives the Fed kind of
and
a foundation.
And it's the October read, too. That already happened.
Yeah, but like a trend line that
right.
It continues, right? Mm-hmm. That it's not just kind of a blip on the data screen.
And Nadia, one thing I have to ask you is it does seem like every piece of data we get is sort of feeding that narrative right now. I mean, is there any data that you can point to that we've gotten over the past couple of weeks that actually says that there is not going to be a soft landing?
Of course, we continue to watch some of the ISM data, particularly on the manufacturing side. That's been in contraction for quite some time. I mean, it was encouraging to see services, improve, but that's something that we're watching. And of course, as we all know, we're all watching the labor market because, any sort of weakness in that will impact consumer spending, and the consumer has been helping to prop up this economy. We're hearing continued positive commentary from some of the banks this past week at the industry conference about the consumer. And so if the consumer gets concern about, possibility of job loss, and we could see a stalling in consumer spending, and that would not equate to a soft landing.
All right. So would you suggest any kind of changes in an investor's portfolio here on Wednesday, December 6th? Or perhaps do you wait till after the Fed meeting next week, or do you just kind of sit tight and wait for 2024?
I think at this point, the year has been already made, and you sort of sit tight and wait for next year. And if you do get a pullback in the market, assuming that the growth data still holds in there, then you might want to consider buying that dip. I mean, the market has had a pretty strong rally, but from a positioning standpoint, we're maintaining our position in terms of being positive on tech into 2024. We do think that there's opportunity in energy, particularly on this pullback. It's been very painful for the last couple of months in energy. And then you want to add some, defensive exposure in terms of consumer staples. But overall, we think that you want to maintain a quality portfolio. So those stocks that really continue to deliver a high return on invested capital, those stocks that still have, those companies that have strong balance sheets.
What kind of pullback could we see?
You could see some consolidation here, some digestion, which we actually think would be healthy for this market after such a massive rally, the best that we have seen all year. And we did have a strong year to begin with. And so some consolidation would be healthy. But we think that that's likely to be short-lived. You still have some potential seasonal factors that could be at play here, the typical Santa Claus rally in the January effect. And you still have some buybacks that could help support this market. And overall, you have the earnings recovery. So that's why we don't think that there's much downside to this market. The earnings recovery should continue to gain some momentum into 2024.
Well, that's what I want to ask you fundamentally. Like, we can all speculate about what the Fed's going to do, what they're going to say, but ultimately they're going to say and do what they want to when they meet and discuss, and then we'll get the outcome. But having said that, fundamentally, when you look at valuations, and there's a lot of different ways, right, to dice and slice in terms of market caps or growth versus value. But when you look at it, do you feel like fundamentally there is room more for equity gains?
Yes. I mean, you finally have earnings back in the black. The consumer's holding in there. And so we think that you can get high single-digit earnings growth next year. And if the economy remains on solid footing, you could even get double-digit growth. I mean, even like a sector like tech, where you say, wow, the sector is up a lot this year. Is there still more left to go? We think so, because when you look at tech, this is a sector that could deliver double-digit growth next year. For our stripping that of the market, it's not cheap. Yes, but it just does have those improving fundamentals that's happening, and it does tick the box on the positive side of the ledger. And a lot of those things that I talked about, quality in particular, and you are seeing continued momentum in AI. We heard that coming out of the UBS tech conference from last week. Mm-hmm. The overall tone has been encouraging, and you're seeing a bottom in the semi end market. So the point is that things are improving for corporations, despite the fact that you might see some slowdown in the economic data.
Interesting. All right, good stuff. Hey, listen, thanks. And if we don't see you before the end of the year, Happy New Year, Happy Holidays. Nadia Lovell, of course, Senior US Equity Strategist at UBS Global Wealth Management, joining us on Zoom in New York City.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.